So without further ado, let me start off by introducing Eslam Nafie first. He has got over 20 years of financial services experiences. He currently takes cases of wholesale. He currently takes care of wholesale banking and regional. He's a regional head for Sharjah Northern Emirates of United Emirates Bank. He was a senior vice president heading contracting portfolio at Union National Bank, and he has a very deep experience and knowledge of business and corporate banking within the UAE. Then the next gentleman we have is Mr. Bob Kaiser. He's another expert with over 20 years of financial services, currently heading the institutional bank of Abu Dhabi and head of energy. He has a Dutch, well, I don't know this, I actually don't know. He's a professional basketball player, and he worked at ABN AMRO as head of trading and commodity finance, as well as head of metals in commodities and at the National Resources. He also worked at Rabobank and PwC. Then we have Mr. Mohammad Abdul Razak. He is the wholesale bank expert who has with the Emirates NBD Bank. He is currently the senior vice president, head of public sector wholesale banking at Emirates NBD. He held various roles at HSBC as a regional head of strategic alliances and business development, the head business banking, managing large corporate and public sector sectors in his part of his portfolio. Welcome, Mr. Mohammed. And then last but not the least, we have Mr. Faisal Hasan. He is a CFA charter holder. I think the CFA charter holder qualifications is one of those things that many people aspire to, but in any case, welcome, Mr. Hassani. He's a noted speaker in many international regional investment conferences and is widely quoted within the media, sharing his views on the regional economic scenarios and markets. He's currently an independent consultant and was a former executive head of property investments and treasury at Kamco. He also has more than 20 years experience in investment and research and asset management across different geographical areas and asset classes, and he held roles at the global investment banking house in Kuwait as GE Asset Management, and is highly ranked through his leadership. Right, without further ado, I think the conversation has been quite good. I've got a few questions, so what I will do, I will ask the panelists questions direct, and if there's any questions or anyone they want to add to it, they must all times feel free to do it. And then obviously, as the questions would come in from the chat, I will also ask those questions to the panelists as it goes. So let's start off with Mohammed. Mohammed, the first question I want to ask you, considering what's happening out there with all the COVID and the downgrade of demand for credit and all the stories we hear of on credit and no growth and what's going on, what is the current state? What is the current state of banking with referral to corporate banking sector within the UAE?
Thanks, Neil, for the question. Let me start off by setting the scene for everyone on this webinar. And actually, before that, I want to thank Phoebe for choosing a picture of mine that was probably 10 years ago. I look much younger in that picture. But so setting the scene for everyone, 2020 was a year of massive uncertainty. It's a year that we've seen events that never happened in the past. A combination of the COVID-19 impact, the political tensions that were there across the world post the COVID-19. It was US election year. There was a reduction of the plummeting of oil prices to levels that we've never experienced. There was a lot of uncertainty, which obviously impacted global economic trade volumes, economic activity globally, and that is all documented. I mean, in terms of the IMF report, which was established and Jamal brought reference to earlier on. But in terms of corporate banking, a couple of things that we've seen. Corporate banks have been very busy in terms of monitoring exposures that they've had to different industries. We've seen the hospitality industry, for example, the retail industry under a lot of stress in the beginning of the lockdown period. And corporate banks were actually busy looking at cash flows when that happened. The second part would be central banks support schemes that came into place, which in the UAE was extended until June 2021. We were making sure that we were there to offer help to the corporates that needed the cash flow enhancement, and to make sure that we were there on the forefront to help them get through these periods. Third thing that happened within corporate banking in specific was the safety of our customers and our employees, which was something that we, as banks overall, or as any employer overall, you had to be extremely agile and adapt to different mechanisms of working from home and things of that sort. So there has been stress that had to be looked into, but at the same time, there were a lot of opportunities that came through this period. I think digital has been the biggest winner when it comes to what happened through last year. We at Emirates MBD corporate banking, I mean, we've seen the digital adoption in terms of transactions go up to 98% of our total portfolio. We've seen 40% enhancement in new trade digital transactions happening or going through our counters, which has been a huge difference in what the banks had to offer. And banks that invested early enough into digital have seen the fruits last year when it came to overall looking at the returns on these investments that they made. But going forward, there is reason for optimism. I think here in the UAE, we have one of the fastest vaccination deployment programs, which is being pushed by the leadership. We have Expo 2021 coming by the end of this year, which we should see some economic activity gain, specifically if globally borders are open and we see more people coming into Dubai in specific. The weaker dollar would help the overall economy here, which would then help investments coming in. The low interest rate environment would be another thing. Firmer oil prices, things of these sorts would help economic activity, which would then help banks and corporate banks further expand. Another point that I would want to throw some light on is that loan growth rates in Q4 of last year have been slowed down within the private corporate world. And that is directly, I mean, there's a direct correlation by investment appetite and capex or expansion loan provision by banks. We've seen limited appetite in that space. So corporates were still nervous in terms of looking at where opportunities lie, whether it's the right time to invest or not invest. And that's why there was slow growth and new loans that were provided by banks.
Thanks. Thanks, Mohammed, for that. Any other views from the panel that wants to add to what Mohammed said about the current state of corporate banking before we go to the next question? Everybody looks happy. So thank you for that, Mohammed. We'll get back to you just now. I want to ask Eslam, if you look at corporate borrowing within the UAE and you know, the whole concept of the quality of the ratings, the quality of the lending, and all the stories we read every day and we hear every day, and why certain companies do so well and others don't do so well. How is lending happening within the UAE? Do we name lend, or how do we create the exposure that we got on our books from the money we advance to corporates?
Well, good morning, everyone. I believe when it comes to name lending or name-based lending, the question comes, does it exist or not? So the answer is obviously it does exist. In all the banks, in all our banks, we have seen that we do have name-based lending that is part of our portfolios. Is it a good approach? Is it something that is good to have, or is it not? It's very controversial. It has its pros and cons. But what we have learned during this pandemic and the tough period that everyone has gone through in last year, that right now I believe there is a much narrower scope to engage in name-based lending. And that's due to the characteristics of the name-based lending by and large. Because when a bank or a financial organization decides to lend based on only the name, then it deprives itself from access to vital and important information, because the main characteristics of the same is you are mainly relying on the market feedback. You don't have access to the most recent financial information regarding the company, and you are basically not taking an informed decision per se from a risk and credit perspective. You lack the background check, you lack the facility type and collateral, and the right pricing reasoning. So it's a bit that you are kept in the dark on so many important aspects that affect your credit making decision. But then comes another thing. Did we see those big names where the banks have lent based on the name going down during the past period or not? So the answer is very surprising that we haven't seen credits granted to name-based lending really going south during the past years. And that's very interesting. Still they are robust, still they are resilient for whatever reasons they are, but that's a fact. Yes, corporates have gone down. There is no big name that is too big to fail, and that's something that we have learned since Enron and until date. And we all know that the profits of 100 good loans can be wiped out because of one bad loan that can go sour. So it's all about the fundamentals. And what we learned in a nutshell is that right now we need more visibility and access to the right information that will enable the financial organizations to take and to make an informed decision. I think gone are the days where we rely only on the market reputation and on the size of the company that tempts the financial organizations to deal with such a company just to take a bite of that cake and to deal with the competition, the fierce competition in the market between the banks, to attract some of the business of the giant businesses that operate, and they refuse to share the right amount of information and refuse to give the access to the correct information that should enable the banks or financial organizations to make an informed decision. So I believe what we have come out with is that it's not as before. Still, the large organizations are a target for banks. Those who refuse to give the right access to information, I believe that gradually they would not be as attractive as before because it's not the market for them anymore.
Thanks, Islam. I want to ask you a question. I don't know if it's a direct question for you, but it's just something that popped in my mind now. I mean, when you talk about information, what is the role or the credit or the quality, or what weighting would you put as a banker to credit agencies and their risk of and their qualification of banks or corporates for that matter when it comes to the credit risk you have to supposed to take?
I want to get your question right. So you're asking about the credit rating agencies, for example.
Yeah, the credit rating agencies. I mean, they would rate corporates. How important is that in your life when you advance cash to the corporate market?
Actually, it's a very big plus for us. We take that into consideration a great deal, because That means that there is an independent body that has gone through an extensive due diligence in order to reach at that rating. And actually, we take that into consideration. That doesn't mean that we rely only on the credit rating agencies. We have our own due diligence, but definitely that adds comfort and it adds to our the accuracy and the robustness of our process.
That's interesting. Now, when we talk about the banking, the advancement of cash or credit to the banking sector, have we seen a change in the GCC and sort of reliance of a cash flow stream versus collateral being advanced for credit? Has there been a change?
I'm sorry, I didn't get that because I got a phone call, so I had to disconnect. So it's a please come again.
Sorry to continue. Maybe just interrupt. Maybe we could go touch upon the name lending aspect for a brief second. I think absolutely, I fully agree with Eslam. I think two things for me to consider. I think one is historically the position where banks were and the overall level of name lending in an overall percentage of the portfolio. I think we're definitely seeing a shift towards having that decrease. I think historical patterns in terms of relatively small depth of market in the UAE meant that it was a more cohesive, well-known environment to start with, which facilitated the name lending element. I think with the influx of more international companies, the market becoming larger just in terms of overall size, GDP, market participants, banks, I think that the appetite and the ability to engage in name lending has reduced. Well, I think we are clearly seeing a shift with some of these counterparties, despite the heavy competition on those names, that it simply isn't as much accepted by banks going forward. It won't switch overnight, but we're seeing steps in the right direction, whether that's with executive member committees or board members having the various discussions with the principals versus having the RM immediately go from 0 to 100 and being engaged to be able to ask all the relevant questions. I also think there's a role for the regulator in this sense. I think if we look at so one of the questions pop up in terms of IFRS 9 and in terms of the overall robustness of the system, I think the UAE economy as a whole could benefit from regulatory changes in that sense as well, whereby sort of banks are assisted in their ability to ask for certain things for the overall good of the economy. I think obviously if you look at last year, the defaults in the market, there were some sizable defaults that affected many of the bank's participants, and as a result affected many of the other corporates and institutional clients by sort of trickle-on effects and having to deal with the increased proof of burden for financial or other questions and due diligence. So I think collectively there is a role for many market participants, whether it be regulator, the financial institutions themselves, or even the larger corporates, to manage that process collectively.
Thank you. Mohammed, you got any value to add, or you want to add to the conversation?
Yes, Anil. So just to complement what Eslam and Bob just said, I think risk assessment is continuously evolving. If you go a couple of decades ago, specifically in this part of the world, it was a very small community. Everyone knew everyone. Everyone knew people's capabilities and things of that sort. We then moved from that to looking at financial documents and balance sheet strength and collateral-based lending and things of that sort, which post to the last financial crisis changed to cash flow-based lending. Everyone was after the cash flow and payments and things of that sort, which now is evolving to even further strategic direction of management, their capability to adapt to different situations, how agile is their business. Things like COVID happen again, and I'm saying this because we were having a discussion with Risk the other day, and one of our colleagues in Risk actually mentioned this. So what if something like COVID happens again? How ready is this company? So risk assessment continues to evolve, and we've seen that. I mean, if you look at what happened last year, and I know I'm going away from the name lending topic a bit, but if you look at what happened last year, industries under stress were industries like hospitality, the mall business, tourism, airline, and you saw some winners over there where they transformed their business model. You had parking lots and malls that had converted to PCR test centers, and they were generating revenue through these things. And going forward, these things will become more and more important.
Okay. Yeah, I mean, I understand, and actually quite a good answer that. I think that is just a different way of looking at opportunities that presents itself in this difficult time, because I think, there's a lot of stuff, we can have two ways. We can just look down and not look up, but we have to look up and look at different opportunities. Mm-hmm. I mean, I think it's a good point to touch on. I think, let me just move on to this whole outlook on oil, because I think that's going to be quite critical as well for the sector, not only for the sector, but not only the country or the GCC, but I think for the whole world economy, is what is going to be the outlook on oil, the impact of oil in the market, and the impact of oil, a rise or decline in the oil price on the corporate debt sector. Take into consideration that certain of the oil companies, I mean, they're all common, like BP, Shell, whatever, it's announced massive losses. So it's a very difficult, contentious issues, considering that the prediction of the oil price rise next year is somewhere between $45 and $50, and you have seen an increase between 25 and 35% in operational costs. So I think it's a difficult thing, and it's something that we need to understand. So, Faisal, do you want to start the conversation on the oil?
Thank you, Dr. Neil, and it's an honor to be here. Yes, it was a very interesting market to say last year on oil, where I think we will all remember in future April, where oil actually went negative, which was sort of unheard of by us. And it's a combination of the demand and supply factor. The demand last year went down by 10%. So the overall world demand was around 90 million barrels per day. And the supply was 93 million barrels per day. And then we saw the cuts and the kind of supply decline that we said. And in 2020, the average oil was around $54 a barrel. Now, I think where the price is, the sort of consensus estimate, which I agree to, will be in the 50s handle, around $50 to $55, with a jolt of upside and downside in between in 2021. Again, the kind of increase in demand that we have lost, especially from the sectors like aviation, we don't see that coming back as to the pre-pandemic level. And we might see a decline, reduced demand as compared to the pre-pandemic level. So that will put some pressure on oil prices. And yes, OPEC and oil producers are doing the cuts in order to put a sort of a floor on the price, or in order to firm the price, because it has a direct bearing on the macroeconomic outlook of the world, definitely on the commodity, because of the commodity prices, and especially of the region. Because if you look at the break-even oil prices for the GCC countries to sort of break even their budget, if the oil prices remain at around $55 a barrel, barring Qatar, every country has a break-even price which is higher. So they will have to have a deficit which they need to fund, and that's where the bond markets come into the play, where they'll be funding those deficits resulting from the low oil proceeds by issuing bonds or dipping into their assets. Again, it's going to be a volatile market, but we see sort of oil prices not going to the pre-pandemic level, and the kind of estimate that we see will be in the range of $55 a barrel, and the kind of liquidity that will come from the oil prices will not be of that level. So that will sort of spur the governments and the macro policy experts to tap the bond markets, which will increase the depth of the bond markets.
Well, I mean, I know you're an oil expert, so let's hear your view on this.
Yeah, no, I think it always has been one of the more interesting topics to discuss, not only just simply because we're in an oil-rich environment, but also because it has impact on a global scale. I always like to look at, perhaps why did the oil price, or why does it oscillate so heavily? I think we look at the number, the crude oil price, Brent crude, WTI crude, but the value of that actual barrel is simply a breakdown of the various products that it generates and the demand for those products, right? You've got gasoline, you've got fuel oil, gasoline, naphtha, the different products that through the refining process ultimately go into end-use products. I mean, a barrel of crude oil you can't really ignite, you can't put in your car, you can't cook with it. But the different individual products that it yields from a refining process have a demand, whether it goes into plastics, whether we use it for our cars, boats, and transporting all the goods that need to be transported across the world. So I think that's one element to it. Then obviously, if you look at the paper trading market these days, the financial derivatives market on oil and oil products is a vast multiple of the physical market. If we look at, and we're touching upon it later in terms of a fiscal bazooka that went off in terms of money printing and additional liquidity into the market, a lot of that found its way to the oil paper trading market, which simply added to the volatility. Anybody with an app on his phone can buy futures in oil and go short and go long. And I think definitely last year, with huge swings, people had opportunities to make money on it. So I think a third element for me is then the geopolitics. I think we've all obviously are fully aware of OPEC and its impact. But then if we look at the troubles that OPEC had perhaps last year and the role that, for example, Saudi wanted to take as part of it. If you combine that then with the pandemic and people perhaps looking closer to home to protect their own interests rather than saying, yes, we've got a global oil oversupply of 7 million barrels. You know what? I'll volunteer 5. If you look at the UAE, we produce roughly 3 million barrels per day. So if you look at the $30 per barrel drop, that's close to $100 million per day. That is not being produced or revenue not towards the government for various support initiatives such as the test program, small medium enterprises being helped out. For me, if we then look at sort of in more drill down into the defaults that we saw into the market, I think from a perspective, we didn't see it on the major players. We saw it mostly on the sub segment of the market, service providers, subcontractors of those service providers, parties that perhaps generally are already over leveraged, and where we put too much emphasis on continued growth of the sector, overestimating the balance sheet cash flow statements perhaps. I think banks are partly to blame. I think we've given too much liquidity too easily in that sense. I think don't forget, if you invest in an asset, for example, in the oil industry, it takes a long time, right? So you're looking at imagining oil at 60, or based on oil at 60 and the service contracts, I'll add 2 more barges to my fleet, 3 trucks, and I'll order them and they'll be ready year after next. So that requires a certain resilience of a company to be able to wade through industry downturns to survive. I think if you look at the recent rebound in oil price, just to get on a little more positive note, there have clearly been winners. Oil trading companies, the largest independent oil trading companies like Retail Traffic, Glencore, they've made an absolute killing with volatile markets. Shell trading, Total, various companies have managed to save some of the profits that for the overall entity that would have been much larger. So I think for me, going forward, I think we'll see some consolidation here in the local market. There are assets available for sale, service providers, niche roles that they're going to be taken up into larger entities to be able to challenge the market a little bit better. We need to increase risk awareness, both from the individual market participants as well as banks. One nice example we always use is Mexico as a government. They implemented a huge hedging strategy a couple of years ago because they were so reliant on the oil price. I think that's something that potentially we could see from countries in the region as well. Again, as Faisal mentioned, given the break-even fiscal crisis, there is a clear need to lock in a certain minimum level of oil price to protect themselves. I think in the short term, we'll see some more investment from private equity and higher yield chasing parties being engaged in, for example, construction phases versus the operating phase. I think we're blessed globally at the moment with very cold winters and snow everywhere, so people are using oil products a bit more, which is lifting it up a little.
Anybody from the panel that wants to add anything more interesting or add to the debate or the question? Nobody. Islam, let me ask you, I mean, we just sort of touched on this whole concept of risk, and, you know, we talked about risk in different ways, and name risk and everything, and lending and name lending, and all these things. But the question I want to ask you is, Islam, is what are banks actually doing to reduce the risk and effectively pricing that risk they have to take on their books?
Okay. I think the circumstances that that everyone has gone through, we are evolving, and the risk assessment process is not a stagnant theory. It's a very dynamic process, and the banks are learning every day new methods and new techniques and new approaches, how to better assess the risk and how to understand the business. And I believe that's a key element. In order to assess or perfectly or better assess the risk of a business, the approach is to better understand the business itself and to look at the fundamentals and back to basics, understanding who the client is, understanding the market where the client is performing, understanding the history of the client and the behavioral pattern of the company itself, where we are assessing its risk. And I'm sure that there are many lessons that have been learned, and definitely the pricing of the risk is one of them, and also the as I mentioned, the fundamentals of the credit. So right now, I believe the financial institutions and the banks, they are looking at each case independently. There is no one size fits all nowadays. I believe we have to dig deeper in everything. Right now, we are looking at all aspects, and the most important thing is, after all those unfortunate failures and collapses that we have seen, we don't take anything, and the banks don't take anything for granted anymore. It doesn't mean that there is a big name that it can just get away with it, or it can just pass through because it's a big name. No. There is nothing given anymore. So we are examining everything thoroughly and meticulously, and we're asking more questions. And I believe that's prudent, and that provides the right path and protection to both the financial institution and to the clients as well. Because it's in nobody's interest just to extend unnecessary credits for the wrong periods of time, and then we all get stuck at the end of the road. I believe financial institutions right now are not really driven by the competition in the market and the urge to achieve double-digit growth rates and huge profits that they have to report at the end of the year. Because we all learned our lesson right now that these figures and these numbers can be easily wiped out because of one wrong decision. So that's how things are evolving now. So just to sum it up, I believe from a risk perspective, it is an evolving, we are evolving. It is a dynamic process, and it is evolving every day. And what I can say is that right now, banks are not avoiding risk. We are not avoiding risk, but we are tending more to take a calculated risk at a broader scale. Yeah.
Mohammed, from your side, what's your view on this?
Yes, Anil agreed with what Islam had to say earlier. I mean, the way banks are pricing risk is more robust right now. A lot of implementations on return on risk-weighted assets have happened, return on RAROCs have been implemented across the region, things of that sort. But this is one part of funding. Even companies on the way they arrange for funding has changed now. We've seen consolidations happen in the market. We've seen people or companies look at more of equity, the equity side of funding their growth happening. So these things have changed the way banking has happened. And I think all banks would remain. I'm really sorry, I just got a phone call.
No, not a problem.
All banks would remain cautious in terms of lending and making sure that they have assessed credit risk properly before getting into any of that. Over and above that, I mean, there has been more issuances when it comes to on the bond side. I mean, when it comes to public debt raised in GCC over 2020. We've seen $45 billion of government debt or government issuances that have come into the market. And banks have been a part of arranging that. So when we talk about pricing risk, there is an improvement in the way banks have priced risk, like Eslam mentioned. Banks are better insulated this time around. Capital ratios are better than globally. I mean, the overall regulatory framework has been much more robust post to the 2008 financial crisis. Liquidity coverage ratios are better with banks. Capital coverage ratios are better. So banks are managing risk and pricing risk more appropriately this time around.
That's good. Bob, let me just ask you. I mean, both Eslam and Mohammed now spoke about pricing of risk and all those things that's important for banks in the financial sector. But do you really believe that the appetite for taking risk has changed in the banking and are priced at a better level?
To varying degrees, absolutely. I think if you look at the results of banks published over the last couple of weeks, some banks saw 50 to 30% drop in profitability, where others went from significantly profitable to turning a substantial loss. Right? I think underlying reasons vary from case to case. As such, will be the response to your perceived required change in risk appetite. And if you look at the largest banks in the UAE, who obviously dominate from a balance sheet perspective, they are exposed to a systemic risk in the market. So inevitably they finance a subset or a microcosm of the economy and will go through its peaks and its troughs. So they're also less able to selectively switch between different industries, exposures, etc. For them, it will become a question about single name exposures, internal controls, checks and balances, and sort of having a overall approach to the level of risk that they're able to take. Majority of the onshore banks here, I believe, have a strong belief in the UAE economy, and to an extent the GCC economy, and they're not likely to turn that off, right? So I think if we look then conversely to the offshore banks, the Eibfs and all the rest, where the contribution of those offices is much smaller to their bank's profitability, they will have a much harsher reaction to a perceived change in risk for the region, and we've seen international banks pull back plenty of liquidity in that sense. I also always like to focus a bit on sort of the overall bank's incentive versus the individual relationship manager incentive. I think we've got quite some bankers on the call who say, yeah, that's fantastic, but I still have a 15% growth target on my P&L for next year, and pricing this, that, the other, a fantastic risk. I need to perform, right? So how do you, as an organization, marry the two? I think that also is quite a big difference depending on the organization you're in. I mean, if you're in BD or you're FAB or ADCB, you will have a natural sort of weight behind you that you're able to either get business, price business, or absorb any negative impacts. For some of the smaller banks, obviously, we've seen that it can have quite sizable impact. So I think then if you're looking at, as mentioned earlier, IMF projects a 1.3% growth for the economy, whereas I think the average bank has between 5, 10 to 20% budget growth projected for next year. those two don't match, right? So either we're going for different yields, we're taking steps that we necessarily shouldn't be taking. We're pumping more liquidity into the market. As an opportunity, it is there for companies, entrepreneurs to see and to support a wave of innovation. But I also think that, you know, we've seen in the last crises, etc., that we go through waves of risk appreciation where we're like, yeah, okay, let's all slow down, and then, you know what, we're ready, let's all open up again, and we sort of see this back and forth oscillation going on.
Thanks for that, Bob. Let me just change the conversation a bit in the direction of the discussion, and ask Faisal. I mean, we talk about debt and, you know, rescheduling of debt and bonds and finance and all those nice things in life. Now, if you consider that the world is now at its highest debt level since the financial crisis in 2008 and 2009, I think it's roughly, if I remember correctly, it's raised 14% the last year, and is now something like 260% of the total GDP, of the world's GDP. What is your view for the 2021 bond market? You know, the issuing of bonds, the Sukuk bonds, the corporate bonds, and why would they be issued? Will they be issued for refunding, or they'll be issued for new capital investment?
Dr. Neil, yes, 2020 was a record year in terms of corporate debt issuances, and as you rightly pointed out, it reached 265% of the GDP levels, and the debt market was around $200 trillion. Now, we see the debt continue to sort of rise, but it will not be of that level, because we'll see the GDP growth, so that level will probably fall down to 48 to 50% of debt to GDP ratio. Now, the main reason is, yes, that the corporates would like to sort of use the low interest environment in order to raise the debt, but we see a lot of widening of the gap between, let's say, good credit worthy corporates and below. So there will be a widening of the gap in the corporate debt issuances. So I'm talking about the ones that were not that impacted by COVID, like utilities or telecom or technology. They will be able to access the debt market more rather than the others which were not. And if you look at even the reasons that some of the capital expenditure that was sort of deferred by the companies, and here I would again bring the energy companies, as was mentioned by the fellow panelists, that they reduced their capital expenditure internationally by 20-25%. Now that will come into the picture in probably next 1-2 years, and that will require some kind of an increase in debt issuances. That will be one. And then there'll be a lot of debt which will be on the refinancing. So coming back to the region, as I said, because of the low oil prices, we might see a sovereign debt will be issued in order to sort of deficit financing. From the corporate point of view, it will be for a mix of capital expenditure projects which were deferred, and for the refinancing. Refinancing will be a big part, where the refinancing of various corporates as well as sovereigns are due in the next 3 years, and there will be a debt issuances. It will be, again, whether it will be a dollar or a local currency. I would say it will be a dollar, because that attracts the international investors. But in some cases of sovereign, probably, if I may take the name of Saudi Arabia, we might see more of local currency debt coming into the picture from the sovereign side as well as on the corporate side, because there's a big market for the local currency debt. And yes, it will be a mix of Islamic. I would say Islamic might sort of outpace in terms of growth numbers. I'm talking about the percentage growth, not the absolute numbers, where we see a lot of Islamic debt coming into the picture backed by the assets. And one thing that might come, which is a new phenomena and which is attracting a lot of institutions, international as well as local, is on the green side. So we will see a lot of green bonds, sustainability linked bonds, ESG, because that is required by the market participants, and that is getting a lot of traction in the market. So if you look at overall, as we mentioned, the macroeconomic growth, which was last year on the global level -3 or -4%, -3.6%, which will now come back to 6%. So actually, it has been a very interesting time for economists like us. We have used every alphabet of English language in order to define where we are going and where we were. So U, V, W, now K is the right word probably. So and that is sort of percolating into the debt market, where it is relying on 2-3 major factors. Number one is whether we will see another round of sort of COVID, or it goes down, the vaccination, and how much the economic activity recoups. So for the increased economic activity, we will see the increased debt issuances. I think from the rates point of view, I think it's now a given that the lower rates will continue for next at least couple of years. You see the Fed dot plot, and that shows that the Fed is looking at keeping the rates at low level. But we might not see that explicit support to the market in terms of liquidity from the central bankers. It will be more implicit. So the market participant might have to look at the debt market in order to sort of raise debt, use the low interest environment, and then go to the growth trajectory.
Interesting. I mean, I don't know if you've seen, Faisal, it was just interesting to me last night. You know, we talk about the markets and investments and growth, you know, how the indices in the world equity markets has performed based on the fact that there's really no economic growth of any nature, just purely in the fact that, you know, we might have a vaccine, we might solve this COVID, we might get out of it. And I mean, Wall Street, emerging markets, every market is just growing at an unbelievable pace. It's unbelievably interesting to see that.
Yeah, you're right, doctor. And the more important point is it's a matter of liquidity now, and the kind of flows that we have seen, the kind of massive liquidity and the central bank intervention that have flows in the financial sector assets. And now we are seeing a little bit of movement away. If you look at the 10-year yields, now it is in the range of 1.2%, which was below 1%. So 10-year yields have been moving up, and it will be interesting to see when the 10-year yields reach 1.5%. What is the effect on the other financial markets? That will be interesting to see.
Yeah, I'm going to see. I think we're getting sort of close to the time where we sort of have to take some questions from the audience outside. But I just want to ask Bob, if you look at the banking sector in general, I mean, I haven't been here long, but you know, at one point in time, I believe there were 50 plus banks, and there's slightly less now. I think there's about 48 banks left in the UAE. Is the sector overbanked? I mean, is it overbanked in the sense that it's limiting growth economically?
Besides the obvious employment desirable question, no, it's not. No, I'm just kidding. I think it's always an interesting question, because I think we related to a couple of things. We're related to the risk in the market, the liquidity, but also I think just from a general economy to sort of optimal placement of capital. Whether we look at innovation, whether we look at investment into companies. Inevitably, after every crisis, you see a flight to quality. As you rightly mentioned, there are roughly 50 banks onshore in the UAE, with another 150 odd offshore, looking at the same counterparties. I think inherently we're underpricing risk. We talked about the low interest environment, which is there to stay for quite a long time. And I think the considerable pressure on net interest margins on banks, and we've seen those results in the last weeks in terms of the drop in profitability. I think if you look at the absolute levels of debt pricing on the other hand, they're much lower because of all these factors, even further helped by an extremely low central bank interest rate. They're not matching by any means the earnings metrics or financial projections for the coming years, but that also, as an underlying problem, gives rise to a scary phenomenon. Say, Libor were to raise by 2%, at the current debt levels that these companies are having, they will not be able to service their debt. I think that becomes then a collective duty almost from banks, regulators, market participants to soften the blow and to sort of deleverage collectively to get to that space. But then again, we come to our individual versus collective objectives. So asking an individual bank, please do less lending, make sure that we get a softer landing, is not our own best interest. So I think, last year and the year before, there was a lot of talk about consolidation in the market. Is it competition or is it value destruction? I think the question is obviously a complex one. I think collectively, as unpopular as it sounds, there should be some parties in the market that will not survive, to sort of have that natural selection. I think even more that will be important in the coming years if the cost of debt and the cost of doing business increases further.
Sorry, I think we lost you. Let me ask Mohammed this question. I mean, I'm running out of time, but I'm now sort of trying well, I'm actually getting in my stride and asking questions. I mean, when you look at corporates, a lot of them has got like multiple interests in companies and businesses they have. Do you see that for companies to survive, a lot of their economic activity will be rationalized or sold off?
Okay, Anil, I missed the last part of the question.
I said, if you look at certain companies, I mean, no matter where you look, you can look at the UAE, where you look, you have them where they do multiple different economic activities of nature. Some of them are extremely successful, some of them are not. Let's just use the concept. You might have people that's in retail, property, and then they in solar panels or whatever. Do you see that there will be a rationalization, a shrinking of these companies back to their core businesses?
So I see a combination of things, Anil. So there will be rationalization in some of the groups that we bank, and there will be collaboration between other of the groups. So the way I look at the market personally is that you will find a lot of collaboration between groups that are doing similar activities, and they'd start working together and see how they can actually create opportunities around infrastructure that they've created or things of that sort. Because being specialists in the industry that you operate in will be something that people will be willing to pay for going forward. And being a jack of all trades would be something that would be questioned. And not only for the companies we bank with, but even the banks themselves. I mean, and Bob was talking about banks being involved in many of the industries, digital becoming a big aspect of banking now. And how the banks approach this would be something that would be questioned. I mean, do you start collaborating with the digital providers, collaborating with tech firms or fintechs or things of that sort, or do you start establishing your own thing? Do you do your incubator? And similarly, like banks, businesses would be going through that same process. So if I have several industries, do I start creating a part that is digital and do everything through that platform, or do I remain in different industries? Business acumen will change. The way people do business will continue to change and evolve. And we've seen, once again, we've seen winners in this. I mean, companies that were focused on e-commerce and things of that sort, even if they were a part of a bigger group, this arm of theirs actually did really well and protected the group from cash flow issues in other parts of the group. So, and that instance, it's helped. So I think it'll differ from a group to another, from an industry to another. One key element would be digitization would be the way forward.
That's really, really interesting. I mean, it's going to be interesting to see what's going to happen over the next probably 18 months within the UAE, because I think they've created a lot of opportunities and a lot of initiatives that can actually add a lot of value to the whole region and actually make them extremely successful. I think at this point in time, I'd just like to ask Phoebe. Phoebe, do you have any questions from the participants or the viewers outside that we can ask the panel?
Yeah, yes, Dr. Neil, we have a question which we have received from Nicola Javanovic. The question is, do we have an estimate of what level percentage decrease in top line and non-performing assets we should expect in corporate for financial year 20? That is one part. So I will repeat the question. Do we have an estimate of what level percentage decrease in top line and NPAT, non-performing assets, I hope, we should expect in corporate for financial year 2020? So that is first part. And the second part of the question is, and how these will translate to different industries that impact on discretionary retail versus healthcare or consumer staples. So anyone like to bring their perspective on that?
I think if I listen, I don't know, Bob, Mohammed, anybody wants to start answer the question?
Yeah, sure.
If I may, sorry.
Okay, Faisal, you start off and then we'll go down the line.
Okay. Regarding the top line growth, it's sort of difficult to estimate, but yes, on the NPLs of the banks, I would say they will probably increase from 4.5% to around 6% level. That's my understanding, and because obviously banks will take on more NPLs and they will be looking at that. And yes, that will obviously reduce the profitability. And I'm talking about banking sector. The return on assets, it should fall from 1.5% levels to around 0.75% levels or 0.5.
Bob?
Yeah, I think it really also depends on obviously the sector, the banks that the sector are active in. I think if we look at our own estimations, and I think the pain that the book has sort of gone through, I think we're slightly more bullish, I would say, than Faisal's answer, in the sense that I think the majority of the clients where we were able to hold hands together and get through the last year, we don't really foresee them to go into massive shocks for 2021. Does that make sense? But like I said, I think that's very dependent on bank to bank to bank, and the concentration risk, the sectors that you're exposed to, etc. And I think for us, it becomes, again, as we've reiterated a couple of times, being close to your customer, having an understanding of the industry segments that they're in, what changes are they making, adaptability of management is absolutely key, as Mohammed mentioned earlier. And to have that collective discussion on how can we protect our books jointly. I mean, that's their underlying business as well as our, obviously, investment and loans towards it.
Eslam?
Yes.
Any view on the question?
So actually, what I can add here is that for the bank's NPLs, I believe the major shocks have already been absorbed. And I believe all the banks have decided to take those shocks and to absorb those losses, especially in the past year. And I think we have all seen that very obvious in the results of all the banks. Hopefully in the coming couple of years, yes, there will continue to be some more NPLs, but I personally don't believe that it's going to be as shocking. So I agree with Bob. They are not going to be as shocking as before, and hopefully right now I believe there is a paradigm shift in everyone's approach to doing business, whether at the bank's front or at the client's front. And it's everybody's aim to pass this difficult time. So hopefully you will not see that those shocking numbers. There will continue to be NPLs, but hopefully not to the extent that we have seen before.
Thanks, Eslam. Mohammed, any input from your view, from your point of view?
Yes, Neil, I actually have an input from my point of view. A couple of things, and it basically depends on the economic cycle. It depends on the rollout of vaccination. It depends on whether countries actually get through this phase and borders open up and things of that sort. It depends on the economic activity that happens. Banks are quite well safeguarded. They're better insulated. And I said this in the past, in terms of capital management, in terms of liquidity coverage ratios, banks are better insulated than last time around when there was a financial crisis. Regulations from central banks are much more robust this time than it was in the past. So we are better prepared for any sort of shock. A lot of action was taken last year. If you look at across the market in terms of the way banks looked at their P&L and the way they allowed for NPLs and things of that sort. But going forward, lending activity will remain cautious, and I don't think that we will be extremely aggressive in terms of looking at where to deploy our assets. We'll look at strategic customers that we know well. We remain close to our customers and make decisions on that part. But it depends. It depends on many aspects of the COVID situation, I'd say.
Yeah, there's many variables that can either make or break this
if you just go less than a year ago, and we went from total lockdown to a lot of countries opening up, to tourism spiking in Q4, to again borders being closed down, lockdown in most of the parts of the world, to vaccinations being rolled up and deployed, vamping up capacity and deployed globally, and it will continue to depend on these things. So you'd have to be close to your customers and make sure that you're there for them to safeguard the bank's shareholders' best interest and their best interests too.
No, I agree with you. I think the lockdown and where you can fly and where you can go is probably the thing that gets discussed the most these days in companies around the coffee pot. But in any case, I go. I just want to ask a question. I mean, I could probably ask Faisal because he used to do this quite often, and I think all of you can probably have an input. What's the importance in the valuation you put to a bank or to a balance sheet when you do stress testing? I mean, how important is stress testing in your valuation of the bank or the corporate for that matter?
It is actually, Doctor, and actually even now from the analyst, actually it has now moved on to from the regulator level as well, because now we see IFRS 9, and I saw one of the questions on the chats as well, where IFRS 9 provides much more granularity on the credit process. And the kind of defaults, actually even the definition of default in IFRS 9 and on Basel, now it's more converging. So that kind of puts a lot of emphasis on the stress testing as to what is the impact on the bank with the change in the economic scenarios. So once it comes into the picture, definitely the stress testing, how much is the bank's ability, how much is the bank's creditworthiness, how much is the bank's capital buffer, and what probably the stress testing as well as IFRS 9 has brought to the picture is it brought the business, finance, and risk of the banks much more closer together, so that they can look at the stress testing in order to provide an outlook as to where the bank is and what is the kind of impact in an adverse economic scenario. So as an analyst, we always used to have a major impact, but now I think it's being ingrained into the system and it's going at a sort of a more granular level in the banks, thanks to the IFRS 9s and all those things. So there's much more, and that gives a view to the senior management, to analysts, to the board, to how to efficiently allocate the capital and price the risk, because everybody who is sitting here and who is watching, we are in the business of pricing risk, and how efficiently we are able to price the risk and allocate the capital of the banks. That is the key. And for that, stress testing becomes, if not the nucleus, but one of the major important aspects of how to allocate the capital properly.
Thank you for that, Eslam. Anybody else? Bob, you or whoever?
Dr. Neil, sorry. We have a query raised by Snega. I will just allow her to talk.
Okay, fine.
Snega, are you there? You can ask the question if you wish to ask. So we have allowed you as you have raised the hand. And friends, please bring in your questions in the chat.
You're on mute.
Somebody's on mute.
I think Dr. Neil, you can continue. Yeah, sorry. I think.
No, it's. I mean, is no other any other questions from your side before we take the discussion a bit further, Phoebe? Or
yeah, we have a couple of questions, interesting ones.
Go. So, let's ask them, and we'll see what the panel's got to add value to.
Yeah. So one is, how can banks, especially smaller ones, balance the provisioning policy of the regulators while supporting the client to weather these times? If the banks are forced to put aside more capital due to arrears, they may less have incentive to continue support. That's the question.
Mohammed?
Anyone like to come in, or you want me to?
Mohammed, anybody want to answer? Islam?
Yeah, sure. I think yeah, it's a very straightforward question. I think with also a rough answer at times. It will make the bank more difficult for the bank to become competitive. And as unfair as that might sound, I think it tackles various other items that we have in the market in terms of indeed, do these organizations have the skill set to adequately price it? Do they have the resources to have a full-fledged, credit department, monitoring department, front office staff? Are integrating these banks into larger organizations, does that perhaps sometimes make more sense? Alternative is that you see these banks, they sort of focus on a core segment, which is obviously a higher risk, given the fact that they require higher returns, which will see greater swings in the profitability of that bank. Again, they sort of go hand in hand in being able to weather that storm versus being able to be profitable bank and continue as a market participant. But I think indeed these external factors are putting much more pressure on particular smaller organizations with regulatory requirements, capital buffer, liquidity requirement, reporting requirements, KYC, compliance departments, you name it. So the cost of doing business for banks has definitely steadily been increasing, which makes it tougher for smaller organizations.
But Bobby, saying that the cost is increasing, I think well, at least at one point in my mind's eye, I think, you would have said to me, well, you're going to do fintech and digitalization and everything. My first response would have been, well, that's good for me because it should become cheaper. But it seems that it doesn't become cheaper. Sorry,
so there are two sides to that one. Easily, I think if you look again, if we take I think an interesting statistic back in the day was HSBC spent more on innovation than the net profit of the second 5 banks in the UAE's combined net profit together, which also means if you need to digitize and to innovate on all of these end-to-end processes, because that's typically where the difficulty lies as well. You can't simply have the front digit, the window towards the customer digital, but then in the back end, everybody handling it manually. But then especially if you look at, as we've mentioned, the changes in how to evaluate risk. If we use our models from the 60s and the 80s, they're completely useless if we digitize them today and use it for a forward-looking tool. If we look at the compliance side of it, the sophistication of which banks are impacted at times by people with bad intentions, the level of detail and investment required to make a robust setup for banks to protect the banks and the shareholders' interests, and thus ultimately the ability to service customers again, is very difficult and costly. We then look at simply, if you look at a retail model versus a wholesale banking model, huge differences in the cost or the ability to digitize a process. A mortgage, yes, I can in theory do it relatively quickly, upload 3 documents, does it tick the box, yes or no, thank you very much, loan is first. When you're speaking to a multinational, infinitely more complex. So the variability of banks to look at digitization and thus reduce the cost significantly is a complex one.
Mohammed, what's your view? I mean, you brought it up right up front, when you talk about digitalization and the impact of digitalization on the whole, corporate finance and the banking and advancement of cash. What's your view? I mean, because you worked at HSBC as well, and Bob just referred to the amount of money that HSBC spent on research for making things work better.
So a couple of things, Emil, from this perspective. Number one, you spoke about the cost. More and more research has shown that customers are willing to pay for convenience. Yeah. So cost is not always about cost of operations or cost of conducting operations with a certain counterpart. And that's not only, I'm not talking about a bank only in specific here. I'm talking about everywhere in the world. People see the value in something and then spend based on the value. So cost is not always something that would be the key area of investment for the bank. We don't look only at how we can reduce the cost for our customers. We look about overall how can we what would the customer journey look like? What value are we adding to the customer's life in terms of providing this digital service? And these elements are always there in terms of looking at the overall pricing element that you would provide to your customer by the end of it. This is one part of investments, but even at Emirates and BD, I mean, we had a program of $300 million, which was established a couple of years ago to invest in digitization. We've seen across the market a lot of banks investing in their overall capability, and it doesn't only come. And when we speak about digitization, I mean, we're not only talking about the customer interface. We're not talking about what the customer clicks, and we're looking at your core banking system. We're looking at things like advanced analytics. How could you use your information better? Because banks are a very big source of information. And how do you make sense of that information? What opportunities do you create? How do you mitigate risks using that information that you have through your system? So you'd find digitization, I mean, a very big word, but when you break it down, there are so many different things that fall apart of this that you need to look at.
Yeah, it's interesting because, if you look at banks, or any major insurance company, the fact how they analyze their data, basically in the long run will determine the way they profile their clients and what products they sell to their clients, because they can actually track their clients, spending methods, spending habits, all these things through analyzing the data and the credit card slips and all these things, so they can actually build data to fit those things. Yeah, Phoebe, you got more questions.
Yeah, we are having plenty of questions coming up. I know we are reaching the time, but I think this can be addressed. This is from Nicoletta Remlinger. Nicoletta, thank you for the question. So risk appetite is guided at group level, and especially for international banks in UAE. Do you think headquarters directions are to be respected by the local branches? Are headquarters more concerned than local branches? So that is something, a question which Nicoletta has raised.
Eslam? Mohammed? Anybody?
We leave someone from the international banks to answer this question.
Yeah, I'll give it then from my previous organization. So my previous organization, before joining CBD, I used to work in an international bank in the IFC. So my answer to your, should you respect it? Oh, yes. Do they have a different appreciation? Absolutely. I always look at, understanding something that is quite far from your bed is quite difficult for one. But I also, again, look at people's incentives, right? So if you look at the time, for example, our office represented, let's say 5% of revenue for the overall organization. A perceived growth, which is, say going from 5 to 6%, is 20% growth for the regional office, so for the Dubai office, which is fantastic. Everybody's happy. We did a great job. Or to my line manager at the time, as a global business running, didn't make as much difference for him. The CEO made less difference to him, right? Negative impact that or adverse circumstances that would have in the region, on the other hand, would have been receiving calls from the board explaining in the Dutch newspapers what happened in the Middle East. Why is it scary between these countries and those countries? Should we be worried about our exposure cross-border? And to A, get across the full understanding is one, but then again, B, for both of them to value the same perceived risk and the incentives on the upside versus the downside makes a big difference. Every step you get away further from headquarters, and the lower the contribution is to the overall net profit. So if you take the case for large international banks that have offices in 100 countries, no one individual country will be extremely important, most likely. Having an international presence overall has value. But that still means that on-ground presence in varying jurisdictions, whether it be through economic or political things, can have a big impact for the local team, perhaps unjustly so.
Thanks, Bob. Phoebe, you got more questions?
Yeah, we have. Mahesh Pillai has shared a question, and again, this is related to Libor. How would Libor transition or moving to SOFR impact USD lending? How would Libor transition or moving to SOFR impact USD lending?
Faisal, you got a view on that?
To be honest, I don't know much about on the lending part, but yes, the transition is going to take some kind of challenges, and we are talking about overall Libor, which is used to price a $200 trillion market, including the derivatives part, and some of it has been sort of transitioned on the futures and others. But there are key challenges because there will be sort of volatility in the overnight SOFR. Still, there is a lack of industry consensus building on the conventions, and there will be system changes and model development requirements that will be required. So yes, it will take time. There will be challenges midway. There's a huge sort of a change that is coming up, but I think it won't. It will have a very short term impact because the industry then aligns itself from Libor, which it has been using, to SOFR. So there'll be sort of system changes that will be required. There'll be some delays and there'll be some convention issues as well, maybe. But they are doing slowly. It has been implemented in some of the derivatives market, but I think it should be done properly because I think industry has moved in these kind of transitions. They have moved. We have seen the Basel transition. We have seen IFRS transitions. So I think this should be done seamlessly also. I'm very hopeful of that.
Bob, you're an ex-trader out of your history if I read your CV. I mean, in 30 seconds, what's your view on this question? Bob, did you hear me? Look, he's gone.
Yeah, but
so our view in 3 seconds on this issue.
I think I'll give you 30 seconds as an ex-trader because I mean you're going to impress a CV, you know, trading all these things. What's your view on the transfer and the impact on the market?
I think it will be there. I think the more liquid the market, the more depth of market and people getting used to the change, you're able to trade it, you're able to sort of iron out the kinks. I think the second part is what, as banks, we are definitely responsible also to educate our clients and to insulate them from, the moment of change and how to best tackle that collectively. It can't simply be an overnight, by the way, congratulations, this is the new price. And, I hope you got used to it.
Thank you. Phoebe?
Yeah, Mahesh, do you have any more additional questions? You can speak if you like to speak. There is a question which I just saw in the chat, and this is related to, the question is related to the demise part. So probably like on the back of Kodak saga and the Nokia demise, do you think banks are in the phase of facing a similar outcome from cross-industry competition like telcos, fintech-based financial institutions? So what I understand is what are the challenges which banks are facing when new players are coming, especially in the corporate banking and especially in the fintech space?
Mohammed?
Okay, I'm unmuted now. Banking will change. I think that is something that is acknowledged throughout the industry. The way people do banking will change. Will banks cease to exist? I don't think that is going to happen in any shape or form. Yes, you might see a collaboration between banks. Banks will remain will need to be extremely proactive in terms of examining what's happening out there in the market, looking at technology providers. Fintechs are something which banks can work with because they don't have consumer behaviors yet. Tech fins, yeah, those already have the customer base. They already have consumer behavior. They know what people like buying. They know what people like selling. They can add cash supply or loan or things of that sort to as an enhanced product to their platforms, and they might be competition to banks at one point of time. But would banks fail to exist? I don't think that is.
No. I think we agree on that. Phoebe, you got more questions?
Yeah, we just like to offer Mahesh, one of our participants, he like to raise a question. Mahesh, you can.
Yeah, like I wanted to come in with new Libor transition period, which has been given, I think, by year end. And I think there is a chance that it would move to much secured lending, like a Sofr as the benchmark. So I want to know how it would impact the dollar lending, and also on the interest rate swap. Like, we might know that a lot of banks have done the IRS wherein the benchmark is Libor. So how would it affect their positions on IRS going forward? And also on the current IRS, what would be the banks would be looking at to mitigate the risk of benchmark being changed?
Thanks, Mahesh. Thanks for the question. Gentlemen, anybody wants to start the answering process?
Sure. I think this is again where we said I think there's a shared responsibility to help each other transition to these new things. Where again the reference rate will change in I think, as Faisal mentioned, how many trillion worth of derivatives. It is also too important for us not to take this very seriously and to ensure that there are no massive shocks in the market. I think that's one key element.
I agree with that. I'm happy. Yeah, Phoebe.
I think we are approaching the time. We have 2 minutes only.